There are no queues outside the banks this morning. No emergency FDIC meeting, no failed lender being carried off over the weekend, no panic. Everything looks fine, and that is exactly the problem, because while nobody's been watching, almost $8 trillion has walked out of the traditional banking system, and the credit engine that funds small business in America is running on fumes. This is the most dangerous bank run in modern history, driven entirely by cold, hard maths. So today, we reveal the simple piece of arithmetic that started this migration, where that nearly $8 trillion actually went, and why a Fed staring at the wrong dashboard could be set to make the situation even worse. My name is Guy, and this is the Finance Bureau. For years, the deal between you and your bank was in fact a form of theft that you agreed to without really thinking about it. You handed them your savings, they paid you almost nothing, and then they lent your money out at a healthy markup. That was the arrangement, and for decades it held because the alternative just wasn't worth the effort. But the alternative just changed. The average savings account pays around 0.38%. According to FDIC data, or up to 0.61% by some broader national surveys, while a 4-week Treasury bill backed by the exact same government that insures your bank deposit pays roughly 3.7%. That's about 6 times more money for identical risk. Now, picture the moment. Someone sits down, Googles the best place to park their cash, sees a number that's 6 times higher for no extra danger, and moves the money in 5 clicks on their phone. For these depositors, moving their cash is just a routine Tuesday. Multiply that single rational decision by tens of millions of households, and the result is an absolute flood of capital leaving the system. So, where did all that money actually go? Well, it went into money market funds, which are basically just pooled vehicles that hold government debt and pass the yield back to you. And the scale of it is hard to overstate. These funds now sit at around $7.9 trillion, and they hit a record high of roughly $8.3 trillion back in late May. And if you need a benchmark for that, at the absolute peak of the Fed's money printing during the pandemic, its entire balance sheet was about $9 trillion. In other words, savers have built a shadow treasury system that briefly rivaled the size of the Federal Reserve itself. For comparison, the Fed's balance sheet today sits at around $6.74 trillion. So this pool of cash is already larger than the central bank. But the somewhat unsettling part of all this is that there was no disaster, no villain, no dramatic collapse to point a camera at. The money just left. Now, at this point, you might be thinking this sounds like a rerun of 2023, and just to be clear, it isn't. This is not Silicon Valley Bank. No lender is failing this weekend. When SVB went under, it received $42 billion in withdrawal requests in a single day, and it was gone inside about 48 hours. That was a run in the classic sense, fast, visible, and powered by raw fear, with 86% of its deposits sitting above the insured limit and venture capitalists screaming at each other on social media to get out. This is the opposite. It's slow, it's invisible, and it's driven by a spreadsheet. And the biggest banks are perfectly fine, to be fair. The top 25 institutions, the likes of JP Morgan, Bank of America, Wells Fargo, have enormous scale and sticky corporate deposits, and crucially, they can tap wholesale funding markets to replace whatever walks out the door. So, why does any of this matter if the giants are insured and nobody is really panicking? Well, the fact that it's silent is precisely what makes it more dangerous. A fear-driven run has an alarm bell attached to it, whereas this one doesn't. No siren will sound until the credit is already gone. And that brings us to the institutions that can't simply replace the cash, because this is where it could get ugly. Outside the giants, there are more than 9,000 smaller commercial banks in America, and together they hold roughly $5.5 trillion in deposits. These are the lenders that fund your local economy, and they have no wholesale funding desk to call when the money leaves. When a deposit walks out of a community bank, there is no easy way to get it back. And now layer a second problem on top of that. Industry analysts tracking regulatory filings estimate that more than 900 of these regional banks carry commercial real estate exposure above 300% of their capital base, which is the threshold regulators flag as high risk. So, picture the squeeze: a shrinking deposit base on one side and a stretched property loan book on the other. It gets worse though, because there's an estimated $4 trillion in commercial real estate loans coming due between now and 2029, much of it tied to offices sitting at vacancy rates near record highs. A shrinking pool of cash and a wall of loans that need refinancing hitting at the same time. That is two-sided risk, and most equity analysts are underweighting it badly. Now, while this may sound like something for the banks and their debtors to worry about, the reality is that this sort of stuff eventually trickles down to affect ordinary people. Deposits leave and loans follow. Not immediately, but inexorably, because the gap between what a bank pays for deposits and what it charges for loans is, well, the entire reason a bank exists in the first place. Starve it of cheap deposits and it has to lend less, which means the small business owner who gets told no on a credit line in the third quarter shows up as a round of layoffs in the fourth. The developer who can't refinance his bridge loan goes delinquent 6 months down the line. The Iowa farmer feels it in the spring when the planting loan doesn't come through at last year's terms. And none of this makes the news because by the time it arrives, it's already happened. And indeed, it's happening right now. Small business optimism has now sat below its 52-year average for 3 straight months, and hiring plans just hit a 6-year low. Commercial bankruptcy filings under Subchapter 5 jumped 36% year over year in May. The contraction has already started, in other words. Now, keeping track of stories like this one, which affect your paycheck, portfolio, and pension, is hard, which is exactly why we send out the Finance Bureau newsletter. It's completely free, it lands once a week, and it keeps you up to date with the stories that matter. So just click on the link in the description or scan the QR code on screen to join us. And now let's look at the villain of this particular story. The Federal Reserve is watching the CPI, it's watching jobs, and it's watching its preferred inflation gauge, the PCE. And the problem is what those numbers are telling it to do. Headline PCE just printed at 4.1%, the highest reading since April 2023. At its June meeting, the first for new Fed Chair Kevin Warsh, the committee held rates at 3.5 to 3.75% for the fourth consecutive time. But the dot plot, which is just the chart of where each official thinks rates are heading in the future, swung hard. Back in March, not a single policymaker saw a hike this year. By June, however, half the committee, 9 of 18 officials, penciled in at least one, and the median forecast jumped to 3.8%. So, the market is now bracing for the Fed to tighten. But when the Fed raises rates, T-bill yields move with it almost instantly, but saving rates at small banks barely budge because their deposit costs adjust with a long lag. Because of this lag, a rate hike actually widens the yield gap. A wider gap means more savers hit the tipping point and move their money, which accelerates the drain on the very banks that can't replace it, which tightens credit even further. In other words, the Fed could be the accelerant for the silent run, while staring at the wrong gauge entirely. And there's a cruel irony at play here. A big chunk of that 4.1% inflation print came from an energy shock tied to the conflict in the Middle East, with crude oil prices spiking earlier in the year. That's a supply-side problem, and you can't fix the price of oil by making it harder for an Iowa farmer to get a planting loan. But you can absolutely break the credit channel trying. Some Wall Street strategists have warned that the Fed may reach for the hammer of rate hikes in order to win back credibility. But nobody on that committee has publicly addressed what that hammer does to the deposit base underneath them, perhaps because they know it's going to make one hell of a mess. Well, that's about all we have time for today, but what do you think? Does the Fed wake up to this feedback loop before the credit contraction lands on Main Street, or do they hike rates straight into it and accelerate the very drain they can't see? Let me know your thoughts in the comments down below, and if you want to understand the man now steering all of this, you can check out our breakdown on Kevin Walsh and his record right over here. That's all from me for today though, so as always, thank you very much for watching, and I'll see you in the next one. This is Guy, signing off.